What does it take to erase $1 trillion from an industry in less than a week? Not a war, not a recession, not a scandal. Just 5 trading days. And the entire global chip industry, company by company, started bleeding value at a pace nobody had priced in. Nvidia lost $238 billion in 2 sessions. SK Hynix lost $176 billion. Samsung lost $173 billion. Micron lost $113 billion. AMD lost $110 billion. TSMC lost $119 billion. Added up, over $1 trillion. Gone. From companies that had just finished posting some of the strongest earnings numbers in their entire history. Here's why this matters far beyond one ugly stock chart. This is the AI chip war. The one deciding whether America keeps its grip on the technology running every data center on the planet or whether China just found the crack that breaks it. And this week, for the first time, the market started pricing in the second option. Record earnings. Falling stock. Those two things aren't supposed to happen at the same time. When a company crushes its numbers, the stock goes up. That's the rule investors have trusted for decades, the rule that built Nvidia into the most valuable chip company on Earth in the first place. This week, that rule broke. In public, in real time. And almost nobody fully explained why before moving on to the next headline. Here's the headline version. Nvidia's market value dropped roughly $238 billion over 2 trading sessions in late July 2026, days after posting record quarterly revenue of $81.6 billion, up 85% year over year. Net income, $58.3 billion. Data center sales made up more than 90% of total revenue. By almost every traditional measure, this was one of the best quarters Nvidia has ever reported. And the stock got hammered anyway, in the exact same week the numbers came out. To put that $238 billion figure in perspective, because a number that large stops meaning anything if you don't anchor it to something real, that's larger than the entire market value of Netflix. Larger than Starbucks and McDonald's combined. One company lost that much value in 2 days, while simultaneously announcing it had just made more money than almost any quarter in its history. So what actually happened here? And how much of it genuinely traces back to China? Let's start with the piece that's real, verified, and directly tied to China, because it deserves more weight than most coverage gave it. In its own filing with the U.S. Securities and Exchange Commission, Nvidia stated plainly that it is effectively unable to compete in China's data center computing market under the current regulatory environment. Read that again. Not facing challenges, not navigating headwinds, effectively unable to compete. China used to be worth billions of dollars a year to Nvidia's most advanced chips. This quarter, Nvidia's own forecast assumes 0 data center compute revenue from China. Not a footnote buried in an appendix. A formal admission, filed with regulators, that an entire national market has effectively closed. Now, layer a second pressure directly on top. Reports in early July confirmed China plans to let its leading domestic AI companies buy only limited volumes of Nvidia's H200 chips. Approvals restricted to less than half of what companies actually requested. Even where Nvidia technically still has access, Beijing is deliberately throttling how much of it gets used, one approval at a time. And there's a third pressure underneath both of those. Quieter. More dangerous long-term than either restriction on its own. Growing competition from cheaper Chinese AI models, built by labs that increasingly don't need Nvidia's most expensive chips to produce results, serious investors are taking seriously. Not hobbyist projects, not government propaganda. Actual competitive models built on cheaper hardware, closing a gap that Nvidia's entire valuation assumes stays wide open indefinitely. 3 signals. One direction. China isn't just restricting Nvidia's access anymore. It's building an ecosystem that increasingly doesn't need Nvidia at all. Sit with that for a second. What happens to the world's most valuable chip company when its biggest growth market decides it can build around you instead of through you? Here's the part most headlines skipped entirely. Because China wiped $238 billion off Nvidia, makes a cleaner headline than the messier truth actually sitting underneath it. The China factors above are real. They are not on their own. A full explanation for a $238 billion two-day rout. Morningstar's chief equity strategist, Michael Field, said it about as plainly as an analyst can. This decline, he said, appears driven largely by sentiment, not fundamentals. Simply put, a loss of confidence. Nvidia's actual business didn't break. What broke was investor faith in exactly how far into the future all of that growth can keep compounding at the pace the stock price had quietly been assuming. Here's what else was happening in that exact same window, quietly, underneath the China headlines that dominated the coverage. Renewed fears of something called circular financing swept through the sector. Here's what that actually means, in plain terms. A growing unease that some of the massive AI infrastructure deals being announced across the industry involve companies effectively investing in each other, funding each other's purchases, in ways that can inflate demand on paper without necessarily reflecting genuine, independent end-user need. Picture it like this. Company A invests billions in Company B. Company B turns around and uses a chunk of that money to buy chips from Company A. On paper, both companies just posted enormous new demand. In reality, some of that money simply moved in a circle. Nobody's necessarily doing anything illegal here. But when investors start noticing that pattern showing up across multiple deals at once, they start asking an uncomfortable question. How much of this industry's growth is real, external demand, and how much of it is the same handful of companies passing money back and forth to make the chart look steeper than it actually is? The cost of insuring Nvidia's own debt against default for 5 years jumped by the most on record in a single day. That's not a stock market metric. That's the bond market, a completely different and often more sober set of investors, suddenly pricing in real, measurable risk around the company's financial stability. Nvidia insiders had also sold roughly $410 million worth of stock over the prior 3 months. Not illegal. Not necessarily unusual for executives at a company this size, but exactly the kind of detail that pours gasoline on a market already hunting for reasons to doubt a story it used to trust completely without question. And just days before this crash, a report confirmed a Chinese state-backed company had begun mass-producing domestic chip-making equipment, the kind of machine that spent 2 decades being an exclusively Western monopoly. That story had already triggered a sharp sell-off in ASML shares, rattling confidence across the entire global semiconductor supply chain, Nvidia included, even though that particular story was really about manufacturing equipment, not Nvidia's product line directly. But markets don't always separate stories that cleanly. A scared sector sells everything that smells like the same risk, whether the connection is direct or not. So here's the honest scoreboard. China's regulatory lockout of Nvidia's data center chips is real and financially significant. A market worth billions, formally written down to zero in Nvidia's own filings. Growing Chinese AI competition is real. The chip equipment breakthrough rattling the sector is real. But the $238 billion figure reflects something bigger than any single one of those. A market-wide loss of confidence in AI valuations generally, with China's actions functioning as one of several triggers pulling that confidence down, not as the single standalone cause. But why does this still matter enormously, even with that nuance fully accounted for? Because underneath the panic sits a question nobody in this industry has fully answered yet. and it's bigger than any one-week stock chart. Nvidia's own CFO, Colette Kress, told investors at a technology conference in early June that the company was sitting on roughly $124 billion in forward supply commitments. Customers had already locked in massive future orders, stretching well ahead into 2027. That's an extraordinary vote of confidence, coming directly from inside the company, not from an outside analyst trying to talk the stock up. CEO Jensen Huang, around that same period, said AI factory construction was accelerating at extraordinary speed. Those aren't the words of a company quietly bracing for collapse behind closed doors while putting on a brave public face. So the real tension isn't, is Nvidia's business failing? By every available number, it clearly isn't. The real question is how much of Nvidia's industry-defining trillion-dollar-plus valuation was built on assumptions about growth stretching years into the future, and what happens the instant even a handful of those assumptions get seriously complicated at the same time. China's actions complicate exactly one of the biggest assumptions baked into that valuation: that Nvidia's addressable market only ever grows, never meaningfully shrinks. Losing an entire national market, even one that wasn't the majority of total revenue, is exactly the kind of concrete, quantifiable bad news that gives nervous investors a specific, defensible reason to sell, right at the exact moment they were already quietly looking for one. Ask yourself this: if the best quarter in a company's history can't stop a $238 billion freefall, what does that actually tell you about how fragile the story underneath the stock price really was to begin with? There's a bigger pattern worth naming here too, because this isn't an isolated event happening in a vacuum, disconnected from everything else going on this year. This is the same dynamic that's played out repeatedly across 2026. Chinese domestic capability closing a real measurable gap, whether it's memory chips, chip-making equipment, or now AI model efficiency, and that specific development becoming the spark that ignites a much larger pre-existing nervousness about how far AI valuations across the entire sector have run ahead of proven, durable earnings. China doesn't need to single-handedly cause a trillion-dollar sell-off on its own. It just needs to be the piece of news that lands the moment the broader market was already looking for permission to get nervous about a boom that's felt, to many investors, like it's been running hotter than the fundamentals could always justify. So, where does this actually go from here? First, watch what Nvidia's biggest customers say next. Microsoft, Meta, and Amazon were all scheduled to report earnings within days of this sell-off, and their capital spending plans on AI infrastructure function as a direct real-time signal for whether Nvidia's massive order backlog is genuinely as durable as advertised, or whether some meaningful share of it is softer than the headline numbers suggest. Alphabet had already said it would raise its 2026 capital expenditure forecast specifically to keep building out AI infrastructure. That's a clear sign that at least some of the industry's biggest spenders aren't slowing down, whatever mood the stock market happened to be in that particular week. If those four companies keep spending at the pace they've promised, a huge chunk of the panic behind this sell-off starts looking overdone in hindsight. Second, watch whether China's restrictions on Nvidia chip approvals tighten further or start to loosen. Right now, the situation sits at a partial lockout. Limited approvals, running well below what Chinese companies actually requested. Any further tightening hardens Nvidia's zero China revenue assumption into something that starts to look permanent rather than temporary. Any loosening, even a modest one, becomes one of the few genuinely concrete pieces of good news that could meaningfully ease investor nerves heading into the back half of the year. Third, watch the circular financing concern especially closely, because it's arguably the more structurally important story sitting quietly underneath the China headline that dominated this week's coverage. If regulators, analysts, or major institutional investors start seriously scrutinizing exactly how much of the entire AI boom's demand is genuinely organic, real, end-user-driven demand, versus companies effectively investing in each other's ecosystems to inflate the appearance of growth. That's a slower-moving, far more fundamental risk to the entire sector's valuation than any single week's dramatic stock swing. Fourth, and this one connects everything together. Watch whether this becomes a pattern rather than a one-off. A single bad week doesn't rewrite an industry. A second one, triggered by similar fears within a month or two, would tell investors this isn't a temporary scare. It's a genuine repricing of how much confidence the AI boom actually deserves. So let's settle this, because both the version blaming China for everything and the version dismissing China's role entirely are missing real pieces of what actually happened this week. The version blaming China entirely overstates it. Nvidia's own record quarter proves the core business isn't collapsing, not even close. A meaningful share of this sell-off came from broader anxiety about AI spending sustainability and circular financing concerns that genuinely have very little to do with China specifically. But the version dismissing China's role entirely misses something just as real and just as important. Nvidia formally telling its own investors, in a legal filing with the US government, that it currently cannot compete in China's data center market, is not a minor footnote buried in the fine print. It's a permanent-sounding admission about a market that used to generate billions in annual revenue, now assumed in Nvidia's own official numbers to generate exactly zero. That's not vague sentiment. That's a hard, specific figure quietly removed from the model, sitting right there in a document filed with regulators for anyone to read. China didn't single-handedly wipe $238 billion off Nvidia in 7 days. What actually happened is bigger than that and more revealing. A market already nervous about how far AI valuations had run ahead of themselves, already unsettled by financing structure concerns bubbling under the surface, got handed several pieces of genuinely bad, genuinely China-related news in the exact same short window, and reacted the way markets always do when real, concrete information collides head-on with already fragile confidence. Fast and hard. Let's run through the numbers one more time, because together they tell the real story. $238 billion, Nvidia's two-session loss. Over $1 trillion, the combined chip sector sell-off across Nvidia, SK Hynix, Samsung, Micron, AMD, and TSMC. $81.6 billion. Nvidia's record quarterly revenue, up 85% year over year, posted in the exact same stretch as the crash. $124 billion. Nvidia's own disclosed forward supply commitments from customers. 0. The amount of China data center compute revenue now built into Nvidia's official forecast, down from billions of dollars just a year earlier. Individually, these are just numbers from one turbulent week in the markets. Together, they describe an entire industry finding out, in real time, exactly how much of the AI boom was built on ground solid enough to actually hold, and how much of it was standing on a future that just got noticeably harder to promise with a straight face. If you want to see exactly what China did that started rattling this entire sector days before Nvidia's crash even hit, go watch the video I did on the machine that already wiped billions off Samsung and ASML, because that story and this one aren't separate. They're the same war, 1 week apart.